Well, joining us now is a man whose internet fund was up 46% last year, outperforming 98% of his competitors. Ryan Jacob runs the Jacob Internet Fund, joins us on the phone from Los Angeles. And Ryan, you've got some perspective here because you had one of the first internet funds back in the 90s. Is the similarity stopping at just the kind of overwhelming response to an IPO, or is there more in common with the tech bubble days?
I think there's probably less in common than more in common. Obviously, this kind of first few days of action is reminiscent of the kind of IPO debuts we've seen. But, you know, the differences are we're in a much more normalized market today. I mean, if you look across the tech sector, you see valuations really running the gamut from very cheap to very expensive. You know, back in the late 90s, it really was a rising tide lifting all boats, and valuations were pretty extended across the board.
Why didn't you buy LinkedIn yesterday?
Well, a couple reasons. One is we did have some questions in terms of their business model, in terms of how they've evolved it over the years. It's an interesting niche that they've come into in terms of you know, looking for employers to drive their revenue growth and to broaden their business. But in terms of, you know, the next step for them in terms of how they build out that platform, honestly, we had some question marks. And in terms of price, I think it's hard, even if you believe in the company's prospects, I think it's very difficult to justify the prices we're seeing right now.
So the defense for those who say maybe, you know, the price is justified is they look at what happened in the secondary market before the IPO and said, look, people had very little financial information at that point, and yet they had, you know, high valuation on the company's potential. What's your response to that? Is the secondary market just not a good proxy?
It's very interesting because, you know, you're right. People figured that these secondary markets were, you know, pricing these securities at very lofty levels that would be tough to maintain. I mean, obviously this proves that somewhat wrong. I would hesitate to say that it has much to do with the fundamentals and more in terms of supply and demand. I think it's going to be very difficult for them to maintain this price going forward. You know, and I think the reason, again, we're seeing such a strong debut is more about supply and demand and less about fundamentals.
Right. Well, very short supply, right? I mean, there isn't really any other way to access social media unless you go into the Chinese market with Ren, but you don't own that either.
We don't. You know, ironically, we actually, it's funny you bring that up because one of our larger positions is actually Sina.com. Sina has the largest Twitter-like service called Weibo that's been unbelievably successful so far, and it's really growing spectacularly well. So there are other plays out there, but in social networking, they're few and far between, although obviously over the next 6 to 12 months, we're going to see a lot more activity.
So when you say a lot more activity, would you be interested in putting more money to work besides Sina into a Ren?
Yeah, it really
price?
depends. I think you know each situation it has to be treated differently, and you know we'll evaluate at the time. But you know I think some of these companies will debut very strongly and deserve it, quite frankly. Others may not debut as strongly. It's going to be it's not going to be universally this kind of response. I think going forward you're going to see some higher quality companies come out, some lower quality companies come out, and I think as an investor you're going to have to be selective.
Okay. All right. Well, from Jacob Asset Management, joining us by phone, Ryan Jacob, thanks for giving us your insight.